of course, in an environment in which we need to collaborate, both from the public sector and from the private sector, to create ecosystems that can flourish and can bring these services to everyone. One word of caution here is that a lot of these discussions in terms of how to provide these things have been around which technology we should use to provide these services, as opposed to which services we actually need to provide. And I think we need to switch that perspective. We need to start thinking on what is the exact functionality that we want for our economies and for the financial sector in general, and then start delving deeper into the different technologies that we can provide. I think in particular, tokenization, DLTs, and blockchains have significant elements that we could use for certain parts of the transactions. But then there are many other technologies that can actually allow us for the more day-to-day transactions to actually flow much more efficiently than these other technologies, and we have not been speaking so much about those. So my contribution here would be just to take 2 steps back and start thinking more on the functions that we want to create for the financial system around the world, and then go on to the technology, because otherwise we can lose track and we can lose direction.
Very good, thank you. And Xiaonan, please.
Thanks very much, the moderator. Hi, everyone. As been described, I look after digital assets and digital currency for UBS Group Treasury. We actually started this journey since 2018, when we firstly executed the tokenized collateral swap on the R3 blockchain. So it was a very interesting experiences, because we were able to use this technology to actually moving a real world asset onto the blockchain and allow automatic settlement through this new technology. As I have said, that first experiment was 2018, 2019, and now we're 2024. We're still sitting here and discussing, how fast we can push this technology and push the boundary. So the reason I highlighted this is because I think this journey is really lengthy, and the reason is multiple layer. Obviously, the technology is one thing, but a lot of things that we have across during this journey since 2018 is the regulatory and the policy harmonization, is the data privacy, data architecture, and etc. Across the portfolio of digital assets and digital currency topics that we have been leading for the bank. We look after, for example, the capital markets activities, things like issuing our own UBS digital bonds. We're still the first digital bond launched by benchmark issuer, and that has the full liquidity across both digital and the traditional market infrastructure. 375 million UBS digital bonds launched in 2022. Back then, the digital currency was a private issued digital coin on the digital platform. But as we know that with the Swiss National Bank launching the project Helvetia, we will be having the opportunity to leverage a central bank digital currency, allow capital markets issuance and the settlement. So from that example, I would like to highlight that the journey, yes, is bumpy, but we have seen more and more public and private sector conversations and the collaboration that actually bringing the direct benefit to the banking sector and the financial industry. We also looking after the digital currency wholesale CBDC initiatives of the bank, and we're working extremely closely with our corporate institutional banking or the traditional transaction banking per se. Why is that important and matter to this forum? Because from UBS perspective, money is fungible. As we know, when money come from our investors, from our clients, through capital markets or from the transaction banking, they come to the big UBS machine or banking systems, and then we'll be funding our activities across the capital markets, across our loan and deposit books, and many other initiatives. So it is extremely important for us to understand and to be able to process and to distribute a digital format of money, being a fully fledged CBDC, or improve the traditional fiat central bank money into our UBS digital or the traditional infrastructure, and then benefit our end client, no matter being the investors or the corporates and the retail people in the world. So I think I will probably pause here. I think my biggest contribution to today's panel is probably that from a practitioner's perspective or from the banking sectors, bringing our insight and the colors, sharing the pinpoints and the journeys that we have gone through to adopt this technology and working with the central banks and public sectors. Thank you.
Thank you very much. And Dong, please.
Thank you. Very happy to be here. I think my main point is that technology itself can be a double-edged sword. It provides an exciting opportunity to improve efficiencies of the international monetary system, but it could also lead to fragmentation. So policies are really important here. It's not only technology. So let me try to explain what I mean by that. So the international monetary system is really about rules, conventions, arrangements to connect currencies. So it's about how countries pay each other for trade and services. It's how capital flows move around the globe, whether there are restrictions against free movement of capital. And it's also about countries' ability to deal with shocks if you have very large capital flows and payments across borders. So do they have enough policy autonomy to deal with macroeconomic shocks? And ultimately, it's also about a global safety net. For example, the IMF here is a lender of last resort for global transactions. So all of this potentially could be affected by the rise of digital money. And it's a very exciting development because we know that there are frictions in the system. Largely, it has worked very well since the Second World War. The Bretton Woods system has evolved. So I don't think it's necessarily a revolutionary kind of process. Rather, we see evolution. We work on changing at the margin. But maybe if you look back, some of the ways we do financial market transactions will look very different in 10 years' time. So I think the vision in our mind is a multi-railed system. I think we want to promote multiplicity in global payments. The market infrastructure supporting trade and capital flows has been working reasonably well among the developed countries. But for many countries at periphery or developing countries, the costs have been very high, and many of them are not included in the system. Many households and small firms are not included in the global financial system. So technology or the rise of digital money does provide an opportunity for what we call it a extensive margin. Along the extensive margins, then the global financial system can become much more inclusive and more efficient. So that's the good thing. I mean, one particular aspect, of course, is that if you think about how we make payments to each other, at the moment, it's primarily based on cross-border, correspondent banking relationships. And these work pretty well among the advanced economies. But many developing countries are actually, for example, in certain areas of the world, like the Caribbean or Pacific Island countries, they are actually at the risk of being cut off, or they are losing, the correspondent banking relationships actually have been declining, right? So in the future, you can imagine that there are different ways of doing this. For example, the Bitcoin network itself has been very interesting in the sense that it's a very integrated network across the globe. Now, the problem is that Bitcoin is a separate unit of account, and that certainly affects monetary sovereignty. And so for the official sector, we want to promote monetary and financial stability while at the same time improve efficiency. So the challenge here is that can we make use of technology underpinned, for example, underpinning digital currencies like digital assets like Bitcoin for public policy objectives. So here we can imagine that in the future, we can have a global payment system that's multi-railed. Some are still very much based on correspondent banking relationships. There could be other networks that are more based on DLTs with tokenized central bank money, or for example, wholesale central bank money, central bank digital currency, tokenize the bank deposits, so and maybe even well-regulated stable coins. So we can see coexistence of such a system for multi-railed payments to happen. But at the same time, we want to make sure that it's still an integrated system. So interoperability between these different rails, different networks would be extremely important. And at the same time, we also want to think about potential trade-offs between efficiency and stability, in the sense that if we see capital flows become much larger, as I mentioned, there will be more participation by smaller households and firms. Volatility could also be higher. So how do we deal with larger volumes and volatility in capital flows? Do we have strengthened capital flow management measures, or do we need to have safety nets to be strengthened? So these certainly are very key components of the international monetary system. It's not necessarily a desirable outcome that's waiting for us. So it's really policies that will shape the future. So if we want to have a desirable future that makes good use of technology, but at the same time preserves good properties of the international monetary system, then we need to use, really use policies to shape technological developments and guide how these technologies will be adopted. So let me stop here, and we can come back to revisit some of these issues.
Very good. Thank you. And Paul, please.
Thank you very much. It's really a pleasure to be here. In my case, I think my main contribution will be to share with you our experience in Peru and the last 3 or 4 years trying to foster retail digital payments. We started back in 2020 with a diagnostic of the system. In Peru, all the retail payments infrastructure is in private hands. We haven't done much progress until 2020. Almost half of the population don't have a bank account and are not using devices that allow us to do digital payments. So we started with 3 pillars in our strategy. The first one was try to change regulation. Even if when banks had the incentives to create digital wallets and new instruments to facilitate the adoption of digital payments, those were closed loops. So the largest banks created its own scheme and they not communicate each other. So the first pillar was try to force them to interoperate technologically and at the rule level. The second discussion, which I think is the most important probably for today, it was the assessment of the need of a public infrastructure provided by the central bank. One of the key lessons we learned was that the private infrastructures were owned by the players, the incumbents, and they were not allowed to enter anyone. So only large banks were doing or providing this payment service, and no telcos, no e-money issuers were able to be a part of the infrastructure. So it created a lot of distortions in terms of access. So the conclusion was the central bank needs to provide infrastructure that opens access. So I completely agree with what you just mentioned, the importance of opening the access of infrastructure. And the third pillar was to explore the possibility of the need of a CBDC in the future. Because we recognize that probably the private sector efforts might not be enough, given the large amount of people excluded from the financial system. So the question was if a CBDC could add to the ecosystem. But something we learned in the process was that before trying to think about the technology, it was very, very important to start identifying the user cases. So in doing that, we just launched a pilot in order to explore in the rural areas in Peru with unbanked population, the acceptability of a wallet based on a very, very simple way of CBDC. The idea is first to create the ecosystem, great acceptability, to understand what are the needs of the population. And then when we had that, then we will start thinking about what's the best way of putting the technology there. So I think in this journey, we have learned several things, but I just mentioned two. One is the importance of public policies, and the second is the cooperation of the private sector as well. Thank you.
Very good. And actually, I probably should have said it at the beginning. The idea is, when we talk about CBDC, the idea is it's the same money, but in a different format. So today, central banks have issue banknotes, which is a physical token, and they issue reserves, which is a book entry money or scriptural money. And here, the sort of monies that we are talking about are monies issued on blockchain in a tokenized format. So that gives new functionality, and a lot of the interest of our work is to leverage that functionality and possibly to alter the architecture on how payments are being processed. It's not necessarily about how payments are being made, but how they are being processed, and we hope that this can lead to a system that can meet new payment requirements looking forward. So let's start with our discussion. My idea was maybe it's not a good starting point, but reflecting on what the ambitions were in the past, you see, of Bretton Woods, to say, hey, we need to create a new system. The concern then was we need to fix exchange rates. Today, the concern is quite different, of course. It's about fixing exchange rates, but it is to, I think, improving monetary relations, bringing more actors into the system, allowing possibly smaller currencies to play a bigger role. Paul mentioned it's also about financial inclusion, Miguel as well, which is more of a retail, and then at the wholesale end, it's about conducting payments to facilitate international trade and financial transactions. So the use cases, I think, are key. I don't think we should be concerned about the text so much, but indeed, Bitcoin was mentioned. I'm glad, because I think we have the discussion because of Bitcoin, and we are using the same tech to some extent that Bitcoin has been using and popularized. So maybe to kick off, just a few reflections as to the possible direction of travel. It was mentioned the importance of use cases, of cooperation, public policy. The BIS is launching a very ambitious project called Project Agora, with the participation of 7 central banks. So you see that this is becoming very big as a collaborative effort, which I think is a good thing, because cooperation does matter if we want to produce major changes. So maybe your thoughts about what do you think is the likely direction of travel, and what do you see as possibly intermediate successes? Xiaonan mentioned it's a bumpy journey, and indeed, I've been on this journey for 5 years, and I thought we would have been much further ahead than we are at the moment. But so Miguel, everyone maybe reflecting on this, where do you think we should be going, and what could be early successes that you would consider important to take this forward?
So let me first try to present a little bit of a vision of what we would expect of the financial system and the monetary system in particular. So I think the singleness of money is of the essence. We have always had singleness of money within jurisdictions. So basically the distinction between high-powered money, which is the one backed up by the central bank, and M1 is indistinguishable from the perspective of the final users. And I think that has been quite successful, and it should not be modified. So when we think about these new ways of providing these types of functionality, we need to start thinking and have these in the back of our minds on how we can generate a system in which we can have singleness of money within jurisdictions previous to going to cross-border, and to allow for a more efficient flow among different currencies. But this is quite fundamental, and it brings a lot of questions in terms, for example, stable coins and other financial services that have a very direct correlate with current financial services. So a stable coin is basically the same as a deposit taker institution. The only difference is that one gives me a username and a password, and the other one gives me a cryptographic key with which I can move my funds. But in the end, the responsibility of bringing back these resources and making the uniqueness of money is one entity that is receiving deposits from the public, and it's presenting a digital representation of these things. I think we need to start thinking in this way. The European regulation is already establishing elements that are very clear with respect to these fundamental elements, these functionality elements, and it is being very clear in terms of how a stablecoin should be regulated as compared, for example, with an e-money issuer, which is a more common figure. I think we need to keep that track, and we need to keep this vision of replicating this uniqueness or singleness of money, and then allowing for this singleness of money to start interacting with the new world. The digitalization of different types of assets is quite important, I believe, for the new economy to actually flourish and for us to be able to start buying and selling assets in an immediate way, in an efficient way. Does this imply one particular technology? No, not really. We just need to transform an asset into zeros and ones. And whether we use a blockchain or we use other types of technology using centralized entities that might be or might have the trust of societies, might do just as well or even better. So I think that if you dig deeper into what we have been doing and you take away this kind of blockaded vision with technology, you take that away and you go deeper, you find trust. Financial sector is based on trust. And when you think about these new possibilities on making cross-border transactions and whether I could use a smaller currency, it depends on whether the recipient currency or the recipient individual is willing to hold that other currency or not. And this is what brings us to currencies that are used widely because they are trusted by everyone else. I think we cannot fix that with technology. And going back to Dong's points, I think technology is just like one element, but we have another element, which is policy. How we manage to get the policy element so that actually these flows can happen between one jurisdiction and the other. And that's a much deeper discussion and a much more complicated one. Technology is a simple one. And then on top of that, we have yet another dimension, which is politics, and which is some sectors do not want to transact with some other sectors of the world. And then we get into a more complicated situation. So I think going back to these principles and these basic elements on trust and these very simple objectives that we might have, which is, I think we all share. We all want to buy assets immediately. We all want to interact with everyone else around the world immediately. And we want to set some functionality so that the digital economy can flourish. Now, the way in which we get there, one part is technology, we need to work on that, but then the other two parts, the policy and the politics, are still there. And we cannot forget that they exist because this can really take us into directions that might not provide with the results that we're expecting.
Very good. Xiaonan, could you maybe from your perspective, from the commercial bank, why are you doing this? Why are you engaged? And what do you think, is in there for UBS when it comes to adopting, these new mediums effectively? And then maybe we can touch on this idea on regulation, for example. Regulation is a veil, of course, but to be honest, I often find it's being overrated. It's very important, but I think we have the regulation in place we need actually in order to continue our journey. But Xiaonan, if you give your perspective from a practitioner, why are you spending a lot of money on developing this?
Yeah, we haven't got enough money. We should have more to spend on this technology and the innovation, but one day. Anyway, I think thanks for the question. From the UBS perspective, it's really important for us to testing out this technology, but also most important to collaborate with our peer banks, our clients, and our public sector colleagues to create and experiment a financial ecosystem or the future of financial market infrastructure. Because I think just like many of us in the room today, that for the digital currency or tokenization or token economy is still something that's to be explored by everyone. So from a regulated bank perspective, we would like to work with everyone to preserve the 2D banking system. From our perspective, the central bank digital currency or central bank money is always the most safe and the best quality money that we would like to utilize as much as possible. Obviously, tokenized deposit of commercial banks is also something being explored by many commercial banks in the world at this moment. And I think to your point in terms of this journey and the pinpoints and we have come across in the past. So you touched upon the policy. So I might touch upon policy from a different angle. So obviously we want a policy that can come to push this innovation, create more clarity. And I can give you an example where, if we do not have a policy that harmonized enough to push innovation, then we could also delay this journey along as well. So a good example is that when we were, implementing the tokenized collateral swap in European entities, it actually came at the perfect timing when the SFTR regulation in Europe come into effect, which means a lot of large banks, including UBS, have to be able to adapt to this new reporting at the same time to be able to handle the tokenized collateral on blockchain. So that means that for UBS, we've spent extra time and extra money on this. When I say extra time, we're talking about at least 1 more year than we expected to actually bring the first trade live or bring more trades into a production mode. So I think this is the case for all the other banks in the same consortium, in the same network. So this is, I think, is a very strong example to show that if we do not have a policy that can harmonize to bring innovation forward, then it is a time and it is money cost for the private sectors for sure. Also want to quickly touch point on the fragmentation of liquidity. Can't agree more. Actually, last year I was working with the BIS and on this project Mariana. So that was a BIS innovation project involving the SNB, the MAS, as well as Banque de France, to explore the FX and how to bring the central bank digital currency on chain to allow the automatic settlement of the FX through the DeFi protocol. So there's a lot of buzzwords in that, but in a nutshell, like how to allow the central bank digital currency to be operated in a fully automated world. So through that journey, what I have found most is when I'm speaking with our FX desk and the capital markets sales and trading, one of the biggest concerns from the industry is certainly not the technology or the DeFi protocol, but the fragmentation of the FX liquidity pool. So for us, how deep a FX liquidity pool is really matters. And in today's world, as we know, FX is an OTC market, and we do have a different liquidity pools and here and there. But are we going to create a lot more different small liquidity pools, or become not even pools, become pedals, right? That will not necessarily be a good thing for the private sectors. So what we discovered is that a fully synchronized digital infrastructure and a traditional infrastructure, bringing the central bank digital currency and the traditional central bank digital currency, or RTGS, together is something that we think could create a lot more synergy than just creating a very independent little liquidity pools. And this also matters from Treasury perspective. Why is that? Because if we can't handle a central bank digital currency in a fully interoperable way to allow it to go through different value chains of our banks or outside the banks, how can we trade such currency or similar assets with similar characteristics as a higher quality liquid asset, HQLA? So there's a lot of impact that in the banking sector that we have to consider. So I will probably pause here. I can elaborate a bit more later.
Very good, very good. I think this theme of fragmentation is an important one, and Dong, you mentioned it as well, and maybe you can elaborate. We have in today's system many different monies, and the integration of the money market is key precisely to achieve the singleness that Miguel, that you mentioned earlier. I'm confident that we have the mechanisms, but maybe we need to think much more about it. If we bring in new formats of money, that they are also fully fungible with the existing monies we have, so that price formation is not going to be impaired by having more monies sort of in the system. But Dong, you mentioned fragmentation, and Xiaonan mentioned it as well. In the FX market, of course, it's particularly important, but I think it's true for many markets. But could you think of what are possible ways to sort of mitigate the effect that could, in theory, not necessarily in practice, but in theory come by introducing a new medium?
Yeah, no, that's a very difficult question, right? There are different ways to think about this. One is that, as we know that in the development of the even the internet in the beginning, there are different experiments. There were different experiments, and some service providers failed eventually, and others thrived. And of course, the big players now we have now didn't even exist in the beginning. So what does that mean? So basically, you could see different experiments going on at the same time. And I would say for payments and capital market transactions, what is really important is that, of course, you need to scale up. And the scale really matters. The economies of scales in payments is extremely important. So if you want to scale up, first of all, the product or the network has to be very good, so it's the good ones or the more competitive ones that will in the end succeed. But it's also important to be open in the sense that you want to encourage many participants to join the network. So let's work together and eventually have big scales. Now, from a public sector point of view, we don't want to have big networks that are not interoperable, or they have they are isolated islands. So from that point of view, at the economy or the global economy level, we need to have some common standards. Now, what do we mean by standards? What does it contain? I think we are at the very beginning of that kind of thinking. I'm sure BIS Innovation Hub and the fund, we are all going to be involved. I think Project Agora itself and others will provide an opportunity for us to think, how do we scale up while trying to achieve interoperability between different networks? What is the role of standards? What is the role of regulation? I don't think we have answers yet. We need to explore, but there are some, I think, preliminary ideas of how to succeed, and those have to be made consistent with public policy objectives. I'm sorry, we can't go into more details, but that's where we are, I think.
Let me take up on this infrastructure issue. And Paul, you mentioned that one of the key ideas is you put in place an infrastructure and then for everyone to use it. And I think that's in line of what you suggested, this open approach. Just one sort of parenthesis on interoperability, which working with blockchain is a big theme and is often being mentioned. But I'd like everyone to keep in mind, today's system has zero interoperability. Right? Every system is completely isolated, and the only way banks can communicate with one another is through secure messages. So we need to keep that in mind. There is an ambition about interoperability, but we are starting from zero when we take our system as a benchmark. But Paul, if you could comment on this idea of infrastructure, could you imagine providing the infrastructure and then having the private sector, for example, use it? Is that the idea in Peru?
Yes, the idea is to open the access to other payment providers. But as has been mentioned, I think what is key is to set the rules, because otherwise it's going to be very difficult to implement interoperability. But for setting rules, you need to somehow reach a consensus, and that consensus is not automatic. We've been working in Peru to interoperability around a year just to reach minimum consensus about how to implement it, what rules to impose. We are still in the way. We haven't finished to implement that. So why is this difficult? Because there are different interests. There are different perspectives. There are costs involved. If you put some type of rule, probably banks will have to invest more. Large banks will not have a big problem, but small banks probably will have some problem. If you choose a different technology, probably the banks or the infrastructure have been using other technologies. So changing technologies also involves cost. So having a single infrastructure allows to set the rules probably easy in a more easy way, and also to get the possibility that more actors interact with the whole system. So I think I see there a very clear role for public policy, setting standards and also promoting spaces for innovation. So the idea is that the idea of regulation is not kill innovation, but encourage innovation. But reaching this point is not simple, it's challenging.
And maybe could we explore a little bit regulation? Because I think, a lot of people are saying, oh, we don't have the regulation yet in place. One thing is in a domestic setting, the other is probably more complicated in a cross-border setting. But could we maybe reflect on this? Do you see it as an obstacle today, or actually isn't it one and it's just a bit of a red herring?
Let me first pose a different perspective. I believe that we do have interoperability, and let me give an example. So if you take the core banking functionalities of different banks, most of them have different architectures and different infrastructures. And if you would like to modify my core banking solution from the core banking solution of the other bank, you will not be able to do that, of course. But then we have another layer, and this other layer is a payment system, for example. A payment system that settles transactions in M0 or high-powered money, and that allows for interoperability among different ledgers that keep value from a very different technological perspective. So at that level, we do have interoperability for transactions between the banks, and this is why we can actually do transactions in our economies. So if you take the card systems, if you take the payment systems, we do have that level of interoperability. When we start talking about cross-border transactions, this becomes a little bit more complicated because the trust is not as easy. When you're talking about a particular country, most countries do trust the central banks and the singleness of money, and therefore the interoperability is almost immediate. When you're talking about cross-border transactions, we start seeing lots of problems because not all the mechanisms work properly. Yet we do have interoperability when you think about CLS Bank and the cross-country settlement. When you look about some other regional systems that are operating, we do have interoperability there. The problem is to get a full interoperability among all the different solutions. It's a complicated feat because getting that level of trust is quite complicated. Yet it is possible to start working towards that solution just to eliminate the technical elements. So the Peruvian case is a very clear example, and you can see this all over the world. You can take the Indian case with the UPI and see how they have integrated the payments of many different payment systems providers, and they are joining in all with this UPI initiative that they have. I think it all comes back to what is the fundamental layer on whether I trust the other entity that is participating in that particular payment system or that interoperability layer. And this is a little bit what the BIS has been trying to explore. We have been trying to explore ways in which we can manage this interoperability among things that talk different languages. And we, for sure, have different potential technologies that could solve this issue. But in the end, it's not just the technology that has to happen. We need to have this common policy. We need to have this common trust among the jurisdictions and even the participants. When you think about the de-risking phenomenon that occurred because of AML-CFT, you could see that certain parts of the banking sector in different parts of the world were cut out. And this is exactly the problem with interoperability. It's not a technical issue. These banks could connect to SWIFT, they could connect to settlement services, but they were not allowed to connect. So this is a much deeper question, and just trying to achieve this full interoperability, the idea of the unified ledgers that is being put out is I think, a vision to the future on how we manage to get these things to talk to each other. But I don't think we start from zero. I think we do have certain elements that we need to take advantage of, and then we have to build on top of that and to generate all these new services and these other connections that would allow us for a better interoperability.
So just want to expand on what Miguel said. I think when you think about central bank digital currency, it's really to think about one important aspect is to think about the counterparts of central bank operations. Okay, so at the moment we have two forms of central bank money. Basically, that's cash. Cash is open to everybody in the society. Individuals, households, and firms can all have access to the central bank money. Now, the other component is reserves. Reserves at the moment is restricted only to commercial banks, okay? So only commercial banks have access to the central bank's balance sheet. But in the future, wholesale CBDC actually opens up the possibility for you to give access to, first of all, non-bank financial institutions, then even possibly to others, right? Even beyond financial institutions. So is that something we should do? That's a question that central banks have to answer. And basically, the technology gives us the possibility of defining a spectrum of possibilities, right? Of who has access to what types of services. You know, would the central bank feel comfortable if a non-bank or non-supervised counterpart is brought into the system, right? That's the fundamental question. So that has a lot to do with regulation. You know, who can be given access to the, at the moment is RTGS system, in the future is to the wholesale CBDC, you know, can they get intraday credit? Would the wholesale CBDC be operating only in, you know, in the existing operating hours, or it's going to be 24/7? Would it be even foreign nationals? So these are questions that would have a very fundamental impact on how central banks conduct monetary policy. And so it's, you know, this has a lot to do with regulation, I would say, but we don't necessarily have answers yet. It has, you know, has many implications.
Just one comment on top of that to build on that is, I think this is not a decision even of central bankers. This is a decision of societies on how we should continue to provide these services. So if you see the mandates of the central banks in terms of providing the currency and providing means of settlement that are efficient for societies, we could do this in many different ways. And I think it is a decision that societies have to make in terms of how the central bank should provide these functionalities, given that we're facing a new world in which digital settlement is of the essence. So now our bills and coins are not as useful as they were when we first introduced them, right? The physical economy is going down, the digital economy is going up, and now we need to replace our paper and the plastic and metal for bits and bytes, and we can do that in many different ways. And I think it's a societal decision on where we want to go as societies.
Very good. I'd like to explore, I hope this is of interest, this topic about interoperability. And you know, I disagree with you completely because, yeah, because the payment system is operated by the central bank. So it's the central bank that actually is moving the money, you know, from one reserve account to the other. What the bank does simply, upon receiving the SWIFT message, is to then make the adjustment in its own accounts. But the two are completely unrelated, you see. So, but anyways, but maybe for Xiaonan, if you could maybe make us get a better sense of how complicated it is actually to do payments, in particular international payments, because I think maybe many do not appreciate, you know, these long payment chains and how complicated it really is to do it. Maybe that would help as well. Why we are trying to explore completely new architecture, which is a lot about peer-to-peer relationships, precisely, you know, to avoid the correspondent banking chains. And CLS, by the way, you mentioned, I think it's another good example of how complicated things are today. But Xiaonan, yeah, if you could give your, help us understand better, why are, in particular, international payments so complicated?
Yeah, certainly. I think there's a multiple different layers when it comes to the international payments. Obviously, if we look at the whole food chain, right, it will be from the start of the payment initiation. For example, it could be a corporate, it could be a financial institution, or pension funds, etc., sending the money from one part of the world to the other part of the world. As you said, it becomes extremely complicated and a lengthy process if this is a cross-border and a cross-currency transactions. And not only that, today a big problem that the society or the clients of ours are facing is this fire and forget situation. What do we mean by fire and forget? The moment they fire a payment, the initial payment, that's it. They don't necessarily have the transparency, the visibility of where their money is at any point of time. They will not know that, okay, is their money going to be, to be stopped because account is not the right number, the KYC AML is not right, and the other side of the world is probably a bank holiday, a public holiday. So there's multiple reasons for this payment to be delayed and to be failed. So a lot of banks today, like including UBS, we monitor our STP rates, the automation rate, and none of the bank, I believe, can achieve 100%, right? So which means that, okay, for the transaction that's not 100%, for this very small percentage, which are not STPs, what is the reason? And also for the transactions that are already STP'd, how slow they are. So when it's come to the cross-border payment, there's so many different layers of transaction bankings, right? It's not only just two transaction bankings or correspondent banking operating nostril between themselves. There's a transaction banks of transaction banks of transaction banks in between, right? So it is extremely lengthy food chain. When we speak with our clients, so I often speak with our corporate institutional clients, and including the treasurer, the CFOs, etc. When you're talking with them about the distributed ledger technology, the digital payments, they are excited about that. They would like to achieve, visibility, transparency, and 24/7 visibility, etc. But we have to really translate what is this concrete benefits for them. For example, a lot of them really appreciate the fact that they will be able to trace where their money is. They will be able to track, and they will be able to pre-validate their transaction, their payment. So when they need to make the payment, they are sure that there will be no delay. It will be settled successfully on the time they want to. Not too many of them necessarily appreciate automatic settlement, because as a corporate treasurers, it will be a big problem if you always do a same day or automatic settlement, right? It means that you're not a great treasurer. You don't know when you need to pay your money, right? So I mean, automatic settlement is great, but not necessarily the golden key to open the sweet spot of the society, of the corporate world. Another thing I also like to highlight is the technology, or no matter tokenized deposits or CBDC, they are the enabler to create more benefits and public good. When you speak with our clients, a lot of them will highlight some more burning points, right? Like the harmonization of global or the geopolitics, for example. If you're talking with them about how to send money quicker, the question is, okay, calm down. How about we talk about how to move our corporate money out of China back to Switzerland, for example. And some of them might be say, okay, the KYC AML is a bigger problem. Would your digital currency also solve this problem, et cetera, et cetera. So I think to have a direct conversation with the end client to really understand their pain points really help us to shape our digital asset strategy and the product shelf. And also, we need to assess the balance of the benefit we can create and also the technology investment in it, because this is going to be a lengthy journey, expensive, et cetera, et cetera. So it's not a small thing. Last but not least, I also want to highlight something not very technical, but I think is important to bear in mind, right? When we send money within the same bank, UBS client to UBS client, no matter within the same jurisdiction or cross-border, it is not difficult. It can be very fast. And the second, or we call it a semi-cross network complexity, is when UBS clients need to send money to, let's say, Deutsche Bank clients. In this case, Deutsche Bank and UBS, we could have a traditional correspondent relationship. If that is the case, the money is still easy because Deutsche Bank de facto is a UBS client if they use us as their correspondent bank. So that is not too difficult either. The most difficult part is when UBS and the other bank have zero correspondent relationship. And this is the most tricky part. And to make this happen, if we have the mercy of digital currency, we really need a central party to play this orchestrator. So this could be the unified ledger, promoted by Project Agora, or it could be a third party or private sector middleman that can guarantee the settlement, the clearing of digital currency in both worlds. But this obviously not going to be as good as a public sector created solid, the most safe digital ledger, digital orchestrator or unified ledger. So I will probably pause here because there's a different layer of complexity, and welcome to ask questions offline, but I don't want to bore you with too many buzzwords here.
That's great. And I'd love to maybe dwell a little bit on, for Peru, a small open economy, Latin America, of course, international payments, we said it already, it's more a challenge for emerging markets than it is for advanced economies. But maybe before you start, I think it is also important, again, to reflect on the fact that if you want to make a payment now to London, it's still faster if you pack money into your suitcase, take the plane, fly to London, go to the beneficiary and handle the suitcase. It's still going to be faster than if you do an electronic payment. So that we also need to keep in mind. But Paul, if you could reflect on this discussion, what does it mean for Peruvian banks in particular? Do you see new opportunities, how it maybe make it easier for them to integrate into the international financial system?
Definitely. We suffer the same hurdles that has been already mentioned about the cost, the loan change for transferring money abroad. But not only that was the case for cross-border payments, but also for domestic payments. So we understand very well the cost and complexity. So imagine what it means for a person that earns, let's say, $20 per month to send outside the capital money, and it reaches the half of that amount. I mean, it's really a profound effect on the trust of the system. And at the end, what we have seen in Peru as well is that they use exactly what you just described. So they ask a person they know to take the money, the cash physically to that place because it's too expensive. So with interoperability, we have been reaching zero cost for transactions all around the country for transactions lower than $200. So we think that the impact of that is very, very strong. And so we see the potential for that also for international payments. So cross-border payments, if we could reach some platform, some technology that can smooth out transactions in that way, I think the gains for the society, the gains in terms of efficiency are huge. And I think it's worth to go in that direction.
Very good. Just to check on time, how long do we have? 7 minutes only. Oh, sorry about that. Well, shall we take a few questions from the public then? I thought we had a little bit more time. Are there questions from the public? There's a question here. Do we have a microphone? Question there. Shall we collect? Yeah. Let's collect 2 or 3 questions. Another question there. Okay, there. Okay, so 4 questions. We start with start over there and then we.
Okay, I'll start, but maybe we can take all the questions before you answer. I wanted to go back to something you mentioned at the beginning, Miguel, and I think Paul also picked up on this. This is the issue of financial inclusion. So one of my former incarnations, I was the deputy director for Africa at the IMF, and dealt a lot with East Africa. And I'm thinking of Kenya, M-Pesa, Safaricom, extremely successful in terms of financial inclusion. The central bank was not at all involved, except, and I think Paul referred to this, by giving Safaricom permission to do it. The banks, the commercial banks hated it initially. They thought it was competition. It turned out actually that it benefited everybody. But the effect on financial inclusion was huge. People had a mobile phone, there was a small wallet. They didn't need to put money into a suitcase when they took it home to their grandmother, right, in the village. They could just have it on their phone. It had only benefits. CBDCs in Kenya, to me, I don't see any benefit versus what they currently have. So I'm wondering, and maybe Paul, you're best placed, in Peru, what do you need a CBDC for in terms of financial inclusion? Can't the private sector just take care of that?
Can I add in, as I'm just handing over? So I just want to really strongly support Miguel, whose idea was dismissed that politics doesn't matter. When we talk about monetary policy sovereignty, monetary system sovereignty, central bank currency. This is politics, right? So next time you have a panel, maybe you should have a parliamentarian, because
bad idea.
yeah, okay. Well, I mean, you may
Central
not
bank
like,
independence.
there are, as we have learned, if you didn't have to learn the last 5 years, the central bank independence has its limits and should have its limits. So, but that's, we have our private debate on that. But I just wanted to make it, that it's extremely important, and one reason why the project may be slowing is because you have to get the political buy-in.
Okay, yeah, question there.
I completely understand the objectives of financial inclusion and low-cost payments and all that. What I'm really puzzled about is the idea that somehow some sort of decentralized or peer-to-peer technology has to be part of that. And I think one of the really striking points is 15 years ago, we invented Bitcoin. All the people who are serious about Bitcoin end up saying, you know what, peer-to-peer is nonsense. I want an exchange. I don't even want to trade Bitcoin. I want to trade Bitcoin ETFs. And so they completely replicate the centralized institutional balance sheet infrastructure because it turns out that thing existed because it works really, really well, not because some government regulation mandated it to exist. And so I just don't understand the excitement about peer-to-peer and decentralization and what the panel thinks that's going to contribute to all these very good objectives that you stated.
Yeah, fair point. And then the gentleman behind you.
Yeah, you had mentioned seemingly some disappointment that things had not progressed as fast as you'd hoped. I'd just be curious your thoughts on why and the look forward.
Very good. Shall we take it in turn? Any question you would like to answer, except the politics one? No? Exactly. Go ahead, Miguel, you start.
Just very fast. I'll touch on all of them. So the first one, I don't think there is a recipe on how to actually get this full financial inclusion for all the countries. So you have amazing examples in which the private sector has generated this really significant outreach. And then you have peaks on the other side, which is a private-public collaboration. And then you have UPI, which also is a private-public collaboration. So I think there is no one recipe or one silver bullet that can solve all the problems. What we need is to keep this openness so that we can allow these different ideas to just provide services for the society based on these functionalities that are required for the digital financial ecosystem. So is a CBDC the silver bullet? I don't think so. But I do think that as a mandate that we have as central bankers is to provide a settlement functionality for the people. And if we provide this settlement functionality, whether the people decide to use that one or decide to go to M1 and settle in M1, then that's perfectly fine, as long as we have the singleness of money and we can allow people or make it simple for people to actually settle their transactions. In terms of the autonomy of the central bank is fundamental. And I think providing services to society, as I mentioned a little bit before, so we are here, we're a tool for society to provide whatever society needs for the digital economy. In terms of the decentralization, I completely agree. I do think that there is a lot of power in decentralization for places where you don't have trusted entities and for people that don't trust the system. So I do think that anarchists and places in which you don't have a central authority that can provide you with this type of services, they might be better off with a solution like Ethereum or the Bitcoin or so on. But for most of the world, and this is not just the developed world, but for most of the world, we do have trusted entities that can provide these services in a much more efficient way. And I think your example with the ETF of Bitcoin is just right on spot in terms of decentralization. Is not necessarily the silver bullet. Again, I do believe that there are benefits to some of the decentralized solutions. So using the cryptography behind the tokenization to allow for entities that are not necessarily registered in the same ledger to actually settle one transaction if they trust one another in an automatized way might be achieved through tokenization. It could be achieved also through more internal systems on the financial market infrastructure's operator, but tokenization is just one more way of doing those things. Also, if the market decides to go there, we need to be ready to incorporate that into the traditional rails and just go forward. and why it hasn't. I think it's a focal point thing, and it's quite difficult to pinpoint on where people will just focus and generate this focal point on which the money will provide the services.
Xiaonan, would you like to answer some of the questions?
Yeah, maybe very quickly. In terms of financial inclusion, I think different society and economy will have their own different definition about financial inclusion. Like for very developed economies like the UK or the Switzerland, I think it means very different to maybe other countries, right? So, for example, Switzerland has made it very clear that a retail CBDC is not a concern for the SMB, and in reality, the instant payment is going to be implemented across Switzerland very soon. So that is already creating the benefit and the efficiency. And I want to also, just pose a question like, sometimes in developed economies, they maybe not everyone would like to use a central bank account or a commercial bank digital account. That's probably for a reason, not because they are too poor to, be included in the financial ecosystem. And when it comes to the decentralization, I think there's a different debate about decentralization, but actually in reality, some of the decentralization is just a glorified word for saying automation. So I think we really need to look into this more details, because that is too much buzzword confusing everyone. When it comes to the Bitcoin ETF, etc., yes, the journey started very differently 15 years ago, and now why the Bitcoin become a bit more, widely heard than ever is because the trusted anchors like the big exchanges and big asset managers playing a key role here. So you know what, in the end, it's still this trusted regulated entity provides the safety net for many investors that who in the past might not wanting to get their hands dirty with such speculative assets. I will pause here. Thank you.
Thank you. And Don, would you like
Yes.
to?
Just to follow up on the question why peer-to-peer is needed or it's not, or whether intermediaries are still needed. So the precise point of Bitcoin or that network is to say, shift the trust from institutions, intermediaries, or your counterparts to a machine, to a network that's collectively governed by its protocols. And is that efficient? It may not necessarily be the case. If we still have trust in the institutions, intermediaries, then of course it's much cheaper to do transactions. That's why you see the tendencies that we still concentrate trades through intermediaries. But we have also seen that in places, in societies where trust is not there, then of course there is incentive to use such decentralized networks. But it's quite expensive in terms of resources, in terms of energy consumed, in terms of the speed. So it's not easy to gain trust. That also says something about the value of maintaining the trust, for example, that the central banks provide. That's why central banks themselves, when we talk about central bank digital currencies, we are not talking about permissionless networks. We are talking about permissioned networks. That is, we still use quite a lot of degree of trust in the institutions. So that's just to finish on that point. On Roger's point, whether CBDC is needed in countries with already developed e-money schemes, it may not be, but e-money schemes don't necessarily scale up in many other places, right? So I think the journey of exploring central bank digital currency itself does not necessarily to a destiny of central bank digital currency. It's really the process for central banks to encourage innovation, to encourage opening up the system to non-banks, to a multitude of players. That itself is a very valuable process of encouraging participation in payment systems to make it much more open and inclusive.
Very good. Paul?
Very briefly, it's exactly what Don says, the objective of what we are doing with the project of CBDC is to explore the possibility that acceptability can be created in a segment of the population that right now do not accept any type of digital payment, either because it's difficult to access because of they don't trust the system. So we are going to try to assess if this possibility might exist. And we are doing with the private sector. We would like to be the private sector, the ones to distribute the CBDC. So they are going to be the ones that are going to be putting the effort, the resources in order to convince the unbanked to accept forms of digital payment. And in this process, we've been talking with financial institutions. They are not interested. We are talking about e-money issuers. They are not interested. So with this pilot, what we are expecting is to actually invite other actors, maybe telcos, because they have already a large network in rural areas, to take the initiative, and maybe we will have a successful case as you mentioned, as the one you mentioned. Thank you.
Very good. I will also quickly answer some of the questions. On Roger's point, this is a point about retail CBDC, and it's a fair point. We don't need central bank money for small value transactions, and it's a dilemma. And I'm working on the digital euro, and I think the ECB is still, after the task force was created in 2019, is still struggling, I think, to make a convincing case to the general public as to why we need central banks when our commercial bank transactions work perfectly fine. So it's undoubtedly a challenge. On the political buy-in, I'm a little bit not too sure. I think there is a risk that we talk just too much about it. At the end, it's just a different medium that we want to provide. So I think the politics weigh heavily, but I think for the wrong reasons. Privacy is being one. I think it's not the central bank's duty to provide privacy. If citizens have a problem with privacy, they need to go to Parliament, I think, and strengthen their privacy laws. It would be my view. On the peer-to-peer, look, I think the interest in using blockchain is because it's a completely different financial market architecture, and the innovation really is the combination of a new medium and the financial market architecture. Not necessarily to do everything better, not at all, but there are certain type of transactions which work much better using this technology, and those are in particular the bidirectional trades, so payment versus payment, delivery versus payment, and delivery versus delivery, you see. And a lot of the work we do focus on those because that's where this tech is just much better, has a lot of out-of-the-box features, and that's where we see the traction likely going to be greatest. So I fully agree it's not a universal use case, but there are certain use cases where this tech is likely going to outperform by far the conventional systems we have. And the last point on why is it taking so long? Yeah, look, I think my view may be a little bit controversial. On the one hand, I think the incumbents that dominate the system, the big banks, are not necessarily interested in change because they dominate the system. So that I think is a key reason as to why we've seen change to be so slow. It may be changing now. I think key initiatives, and the central banks have been key drivers here. If they see a public policy interest in a more diversified financial market infrastructure, inviting new actors, new use cases, then I think we have a good case to move forward. But it would probably have to be that sort of thing, sort of a high level of conviction that central banks see a public policy interest in promoting this sort of architecture for it actually to work. But I think the case is very strong. CLS Bank was mentioned before. It is settling 40% of the foreign exchange market settlement, but in an archaic way. If you would never, if you have the tech today, you would never design it in that way. So I think there is scope to move and do things much better, and hopefully that will accelerate the journey. Anyway, so we are at the end of our time, unfortunately. I would like to thank everyone very, very much for your participation, for your interest, well, hopefully see you soon again. Thank you.
Thanks, everyone.